My name is Hugh. I look after our investment office of 12 people on a daily basis. I'm honored to be part of this esteemed panel of private markets and hedge fund panelists. I wanted to start off with a report that I read from Goldman Sachs last year on family offices, which showed that the average family office in the US has about 50% exposure to alternative investments, which include private equity, hedge funds, etc. That same number for family offices in Asia will be significantly lower. And then if you look at the exposure that individuals have to alternative assets are almost negligible. The good news is that the industry is changing. Thanks to a lot of panelists out here and the firms I represent, that we make a lot of very high quality private markets and hedge fund investments available to individuals through new evergreen structures, as well as other structures that are available to individuals. So we wanted to take this time today to learn about those evergreens, to learn about how private markets and hedge funds will actually help diversify, just like our title today, your traditional mutual fund and public market portfolio. So before I start, maybe I could give 15 seconds, this time not 1 minute, just to really introduce yourself briefly to the audience.
Sure thing. I'm Henry, and I run the private wealth business for Asia Pacific. Partners Group is a private markets firm. We manage $147 billion of capital. We're known for three things. So number one is we're known for private equity buyout. We're the largest one in the upper middle market space. We're known for secondary investments, and we're known for evergreen fund structures, which accounts for about 30% of the firm's assets.
Hi, Edwin Chan. I look after the business for iCapital here in the region. iCapital is an alternative investment marketplace. We specialize really providing access for the wealth management community, access to the best alternative investment opportunities from around the world. We are a US firm, and out of New York, we have about 1,200 people around the world, about 180 billion of assets that's under our management right now. The strategies we do is basically private equity, venture, infrastructure, real estate, hedge funds. We have basically a full menu of those on our platform.
My name is William Vettorato. I work for EQT. I'm based in Zurich, Switzerland. EQT is new to the private wealth management space, so you might have heard or not about it, but it's well known in the institutional investor space. We're known for being the third largest buyout investor by fundraise. We're known to be a top 5 healthcare investor globally and technology investor. This content is now what we want to offer to a wider set of investors. Nice to be here.
Thank you. Tracy Lau, I'm Managing Director at Carlyle, representing the 200 billion global credit business in Asia. As a firm, we run 400 billion assets across private equity and private credit, and that is making us relevant for today's discussion.
Thank you, everyone. So I'm going to start with Henry. In extension of your one takeaway challenge, I'm going to give you a little bit more time to elaborate what an evergreen private equity strategy is as the pioneer of that strategy in the world. Can you give us some thoughts on how it differs from a conventional drawdown vehicle?
Absolutely, and I'm glad you said evergreen and not the market convention word of semi-liquids. And the reason being is that if you think about an evergreen fund, as I talked about in the one takeaway challenge, an evergreen fund, there's no J-curve. You're fully invested on day one. You have regular windows of liquidity, and hence, I guess that's where the term came from. But more importantly, is that you're diversified across regions, sectors, and vintages. And that's absolutely critical, which we'll get into in a bit. But I think that what's important through our history of running these evergreen vehicles for the last 20 years is there's really 5 takeaways if you think about running these strategies and running it successfully. And the first being having a very robust investment platform, both on the direct side and the secondary side. So for us, we have very strong buyout content. In fact, we're the largest one in the upper middle market space, and we've been a top decile manager for a number of years. In addition to that, we've also been a pioneer in secondaries as well. And that balance between secondaries and direct investments allows you to have a very powerful investment platform to constantly keep investing. Because direct investments are great, but it's very chunky. And so if you can mix that together with secondaries where you have earlier distributions, you go through the J curve a little bit earlier, then it balances all the direct investments that you have within the portfolio. So that's number one. Number two is having a pro rata allocation policy. Now that sounds quite simple at a very high level, but in fact it's actually quite difficult to implement across the industry. And the reason being is that for closed-ended fund, for managers in the industry, about 90% of managers are running closed-ended funds. And the idea of the industry is that you have to give your best investments to the closed-ended fund first before it flows down to any other vehicles. And so for us, we've been running evergreen funds for the last 20 years. And in fact, we built up our structure with about a third each in mandates and closed-ended funds and evergreen funds. So whether you're a sovereign wealth fund or whether you're an individual investor, you get equal access to every single investment that we do across the platform. Now, the third point I want to bring out is liquidity management. So this is obviously a very key topic within Evergreens because you're essentially putting private market content in a liquid format. And so how do you do it properly? So you could either invest it all the way to the full maximum, but then you run the risk of gating. You underinvest and you run the risk of underperforming your benchmarks. And so striking that balance, making sure that you have inherent liquidity in your portfolio is going to be absolutely critical. The fourth point is around valuations. So as we've seen again, if you keep valuations too high, and for example, if the public markets are down 20%, you're up 20%, obviously there is a problem there, right? So keeping valuations current is absolutely critical in evergreen funds because you are striking a market, you are making a market every month or every quarter. And the last point is on vintage diversification. So if you see a lot of evergreen funds in the market today, a lot of them have, they're great investment platforms, but the thing is that all of their investments are at the beginning of the value creation cycle. So you're not going to see distributions until 5-7 years down the road, which is a typical business plan for private equity. And so by having vintage diversification in the portfolio, you already have a natural flow of liquidity to invest into new investments.
So with that last point on vintage diversification, I'm going to actually go to William because Henry, you didn't exactly provoke William, but you were also talking about newer evergreen structures out there. So I guess the question to William is that EQT is obviously known for its fast exits and good value creation, et cetera, but you are pretty new to the evergreen side. So how do you think about how your structure is the pros and cons versus, let's say, something like a partners group?
Well, first of all, as a disclaimer, I used to be a colleague of Henry. I used to work at Partners Group myself. And I totally underwrite all he said. It's very true. I think it's important to understand that this space is now increasing. I had the luck when I was at Partners Group to see a changing market environment dominated by one or two houses has now been much more competitive. I think this for the investors is key. So I would like to emphasize this. And everyone can achieve the result. The portfolio construction is tilted to their strengths. And our strengths is being a direct investor, a lead investor. We achieve diversification across a multiple of investment strategies. We have, again, an expertise in healthcare, which is globally recognized, and it's centered in the large buyout space, but across the investment stage spectrum, all the way down to life science. Now, this content is something that we deliver. At the same time, technology is a sector where we are prominent globally. This content we deliver. Will you find in our portfolio 5,000 companies? No. Is that good for diversification? No. That's over-diversification. You find our portfolio 200 to 300 companies. We'll be able to sit down with you and explain you directly or through distribution partners, how performance is generated. To us, that's the core of our proposal. Our value creation in a lead role, that's what we want to deliver, that's what we pivot around. And in general, I think there's only one element to keep in mind. I think in the ideal portfolio allocation of an individual investor, I think there's space for very different products, each one of them, again, playing at the strength of the company, of the firm, which is offering them. So I think this competition is very much useful to the market and to the investors ultimately.
Yeah, I think it's also helpful that even a single manager evergreen fund is more diversified than what, let's say, Helen mentioned in the earlier panel of trying to choose different vintages for closed-ended funds. So that's interesting. Now, moving on to private credit for a minute, I think that question had come up in earlier panels as well, of comparing public versus private. Obviously, private credit has really been a buzzword over the last 12 months with high interest rates. How sustainable do you think the yields are if interest rates get cut? How should we think about the credit quality, right? Because there have been discussions on floating rates being good for investors, but for the borrowers, it's putting a lot of strain on them, right? So how should we think about that?
Sure, thank you. So I guess it has become a buzzword, and I have to give credit to all of my peers who has done a great job in terms of promoting private credit in the last 12, 18 months. Everyone says it's golden age era days. From our perspective, when you look at private credit, and this definition in the market is very restricted to senior debt sponsor back, right? Floating rate and very highly dependent on M&A activities. So if one of these levered actually disappearing, then you sort of question private credit. But in reality, when we look at the market, the entire private credit market actually is beyond this 1.7 trillion of senior debt sponsor-backed direct lending. If we consider some of the bank debt, high quality bank debt that we see, like for example, student loans, trade finance, inclusive of infrastructure project as a result of energy transition or AI transformation, the entire addressable market is actually at 46 billion. So coming back, 46 trillion, and coming back to this diversification, right? If you are able to build a portfolio across a diversified sub-asset classes of private credit, then you are able to navigate the factors of decreasing interest rate, crowded space in direct lending, how is borrower taking floating rate into their account, right? So if I look at some of our flagship strategy, we're able to maintain a very consistent yield during a zero rate environment, a peak interest rate environment, and vice versa when interest rate goes down, because basically you can pick and choose from a larger addressable market, which is not only floating rate and sponsor back.
Thank you, Tracy. I'm going to move to Edwin, and I'm going to go back to my earlier comment of comparing the US and Asia and kind of looking at how little exposure even high net worth individuals have to alternative assets. So working at iCapital, can you give us some color on, on that comment on how Asia differs from the US, and also kind of individuals' exposure to private markets and how that will play out going forward?
Yeah, thank you for that. I think it's really interesting. When I'm going to get the audience to participate here, at every event when I speak, I usually ask two questions, and I'd like the crowd to respond. The first one is, how many of you are recommending or investing in private equity or venture or any related to alternative today, if you can raise your hand? In the next 12 months, which of you would be interested to learn more or at least do more in private equity? Oh, that's quite promising. In the US, we did that. I had about 400 people. The first question, the response rate was about 70%. The second question we had was practically close to 100. I did the same around Asia. I did in Australia. I did in Singapore. Hong Kong, this is pretty good. But going back to your question, I think that's a few things, I think why, I think the take-up rate is probably not as high. I'll probably share from that perspective. I think, firstly, it's really access to good information about managers and opportunities. I think out in Asia, I think I've been on the institutional side for many years, been doing private equity for many years. You see a lot of very good opportunities. We see at the institutional level, big investors where they put out, at least, 20, 30 million to 100 million plus. For individuals, we don't get to see them. Secondly, it's just really learning about the asset class. You see a lot of these great opportunities in the private assets, 10 years lockup, and people find it hard to lock up as an individual, right? And thirdly, even if they are great firms like Endowus, they have to spend a lot of time to educate the market. Not everyone has that propensity or the intellect to really drive that because it's still a very new asset class. I think what we've learned in the US is I think a lot of efforts have been put in each of these efforts and making these products available. I think iCapital, we've been very fortunate to be part of that process to make a lot of these institutional funds, basically break them down into smaller, available subscription amounts that people can also participate in these great opportunities. So I think that's really down to a few things that make it make it difficult for us to access.
Thank you. So actually, going back to the title, it says private markets and hedge funds, and you're wondering who's representing hedge funds, and it's actually me. So I've worked at 3 hedge funds across about a decade in my career as well. And so, I think private markets, funds, and hedge funds all play a very interesting part within a portfolio to either diversify and or reduce correlation, right? So there are different roles that one plays, and it's very interesting that we're now able to access really, really high quality products for the individual. And a lot of them, I think a key part of having an evergreen structure is that now you have portfolio attribution and portfolio that is kind of consistent with your public market portfolio. So it's quite easy to compare how your private markets are doing. But with that, there is actually a question in the audience regarding marks, right? So I'm going to go to Henry first on marks. How should investors think about the marks of an evergreen structure, which is monthly? It's also different from the closed-ended funds that are normally quarterly and also generally like a quarter behind, right? So how should we think about that in terms of reconciling performance with the public markets?
Look, I think with evergreen funds, we need to try to keep our marks as current as possible because ultimately you are making a market to the investment community, whether it's subscriptions or whether it's redemptions. So making sure that those marks are current is absolutely critical. Now, how does valuations work? At a very high level, it's comparable multiples, and we usually take public market comparables, multiply by the EBITDA of the company, and that's how you get the valuation of the company. And so we're basically taking public market comparables and we're valuing these companies. If there are private markets, we will adjust accordingly transactions, but otherwise, that's where the markets are. And so that's how we're keeping the marks constant, at least in a evergreen vehicle. Now, for closed-ended funds, even if there is any adjustments, there is no incentive for them to keep the marks as constant as possible because you are locked into a closed-ended fund. So I guess the dynamism of an evergreen fund is that, yes, it is going to be a little bit more volatile than a closed-ended fund, but it's because you are making a market from a subscription and redemption perspective.
You want to take something else, William?
I totally agree. I just would like to add a little detail. There is an element in private equity investing. One of the reasons why you like private equity is because the value creation, the hands-on approach. So there's much more of an idiosyncratic element connected to the investments you do firm by firm. So when you put these investments in a semi-liquid funds, I totally agree with what Harry said. You need to be dynamic, you need to adjust your valuations to as close as possible to a price. But you should not get lost in this theoretical exercise because there's so much idiosyncratic element. I can give you an example. SHL Medical is a company that we own. They are leaders in the auto-injectors. This company has realized fantastic returns in the first half of the year because of specific positioning they have in the US. As you know, there's a cure for obesity, which is auto-administrated. In this example, why should I now introduce too much market beta, forcing a comparable adjustment that might not fit exactly the valuation? So holding true to what Harry said, there is another element which is key. You need to ensure that investors don't have the advantage or don't have the incentive to arbitrage on a valuation which, as a matter of fact, will have to be a bit more stickier, but not stickier for the sake of being stickier, much more idiosyncratic. And this you do it introducing redemption notes. This is key, because otherwise you will get lost in trying to introduce public equity beta in a portfolio which might actually be different from the index or the comparables are. But just like a little, I agree with all the rest. I think it's key.
Thank you, William. Just the other frequently asked question for evergreen structures is really on liquidity, right? And I'm going to ask Tracy on that. Actually, there is a question from the floor on, I guess the guest asked it as a liquid alternative, and I would say that it's probably not a liquid alternative. The underlying investments are all illiquid, but how should one think about liquidity in a semi-liquid vehicle?
Right. So I guess this also comes back to your question to when you build either your personal investment portfolio or for an institutions on behalf of someone, right? What is the objective you're trying to achieve? Liquidity is very often expensive, and you will know when you come across it's highly expensive, right? And when in our experiences, when speaking to a lot of institutional investors, there are too much liquidity in their portfolio. That is very often the case. For example, pensioners, insurers, they have a very visible liability, but liquidity tends to give them comfort. And with family offices, generation wealth transfer, some of the generation, they haven't even existed, right? But then they're still holding on a lot of liquidity, which they don't need. So this is more of a question when everyone thinks you want to diversify. This is definitely one factor that you need to consider. But if I were to look at some of the underlying asset for private credit, there are 2 points that I would like to bring out. One is liquidity. Usually when semi-liquid or evergreen funds, they tend to draw on hold to maturity, interest income, offsetting flows that come in. So it's often not guaranteed, and there will be a gating, right? So whenever you allocate to these vehicles, this is a huge consideration whereby you need to look at. A second point is, which is enhancing liquidity for these funds, is first, it is becoming a mainstream asset class, and therefore, if you look at inflows and outflows, you will see a more active inflows that would support outflows, right? So this is enhancing liquidity. And other element is also, as we are actually seeing convergence of the public and private credit market, right? So we often, or a lot of industry players have said, oh, private credit lenders are replacing banks. Actually, we're not replacing each other. We're working with each other. Back in the days, private credit only means senior debt lending held by banks or mezzanine debt held by players like us, right? But if we look at capital stack as of today, the entire capital stack starting from revolvers, meaning your credit line holding on your credit card, all the way down to a preferred equity structure, we can actually participate with the bank, right? So this convergence basically is also enhancing liquidity of the underlying assets, which helps to fund all of the liquidity.
Yeah, can I just chip in here? I think this is why right at the outset we said this is not semi-liquid. We call it open-ended fund. It is a lockup. Underlying, these are private market assets that we're buying. Doesn't matter if it's equity or it's debt or real assets. These are lockup, underlying assets. They're not there supposed to be like your equity or your bond where you get traded. But it does make it easier for people to accept, right? So I think just a bit of history. I think about 4 years ago, you see managers start to come up with product that we call open-ended. At the time was semi-liquid. They just make it easier for people to come in, right, to invest. They can choose the time, and they can invest over by monthly or by quarterly. There's also redemption option, but there's gates as well, right? But I think at the end of the day, you have to look at the portfolio. I think this is a million-dollar question. This is something perhaps Endowus can help your clients with, exactly that, is how do you allocate that portfolio? And I think the more important thing about our asset class, the more important thing we have to remember as investors, is that there are more and more opportunities available in the private market space versus the public market. Because if you look underlying equity, a lot more companies are staying private for much longer before they get listed. A lot of the value creation is created during this stage. So for example, iCapital, we're a private company. We've been private. This is our 11th year, and everyone's asking, when are you going listing? I'm not going anywhere near that. I can't do that. But a lot of value creation has been created during this time before we actually would take that step. And you want to have the chance to participate in that. And this is where the alternative can really help you to access to this layer of opportunities that's available in the market. I just want to raise that point.
No,
It's important.
I would just echo that. I think it's very important that clients understand that the asset class itself, the underlying investments are illiquid investments, and you're getting an illiquidity premium as a payoff for that. But the semi-liquid kind of structure is there in case you do need liquidity, but it's not the expectation to trade that liquidity. It is really an underlying illiquid asset. And my personal experience is that prior to joining Endowus, I was CIO of a single family office for 4 years. There are fund managers, including ones that are here, which our office invested into, but I could not personally because I could not put up $5 million, $10 million of investments. But now at Endowus, I can actually invest in them directly under my name. And it's because of these new structures that are made available to individuals, right? So I think we're seeing a very, very big shift in the way the same investments are distributed to the individuals. And it's our job at Endowus to make sure that the process is easy, it's as cheap as we can do, and also logically acceptable, right? So that's what we do. But I think it's a very, very big change that I think you should take note of for sure. Do you have something to add on liquidity?
A very quick one, and it might be controversial, but I still want to drop it. Most of the good investments are investments where you hold on in moment of uncertainty, where you don't jump and crystallize a loss. So gates are there to protect you from people who want to leave the ship in the moment of difficulty, to protect you from the fund manager, whoever that is, to Salesforce assets. Now, clearly, if that is 100% of your portfolio, you made the wrong decision. It has to be a small portion up to your liquidity profile. But gates are there to defend your interest and to hold on to moment of market uncertainty.
Do you want to add something? Everyone added something on
Yeah,
liquidity.
okay. Well, look, I think that we've proven it can be done. Over the last 20 years, we've never had to gate our flagship Evergreen strategies. And I think that at the end of the day, it's how do you plan for liquidity events, right? And so you obviously have cash on the sidelines, you have syndicated bank loans, but it's also making sure that you have investments that are diversified across vintages, so that you have distributions coming back to fund new investments and making sure that you don't take in too much new capital. And so we were one of the few managers in the market that turned away capital back in 2021. And that helped because if you limit the amount of capital that you're deploying in a particular year, then you're basically limiting the amount of vintage exposure that you're getting for that particular vintage. And if you're able to get that diversification profile, then it builds a natural flow of liquidity, and we're not dependent on just fundraising.
Thank you. I'm going to go with a question that's also somewhat controversial, which is that the demand for institutional demand for private equity in particular, but even private credit, has tapped out a little bit. And a lot of managers are looking at private wealth, looking at individuals, and looking at different structures, right? But the question asked was, how do you avoid the products being offered on the platform don't become the failed products that attract institutional investors, and will Endowus become a distributor for these inferior products, right? So I guess the question is really on, are individuals going to carry the bag for the institutional investors? How should we think about that? How do you, as GPs and distributors, think about that question?
Okay, well, why don't I start? And as I mentioned in the 1-minute takeaway challenge, is that a pro rata allocation policy is absolutely critical. Whether you're a sovereign wealth fund, whether you're an individual investor, you have to get equal access to all of the deals across the platform. And I think one of the big challenges across the industry today is that most GPs have their funds structured as closed-ended funds. And so inherently, all the best investments do need to go to the closed-ended fund first. Now, not everybody is structured that way. Evergreen funds are becoming a larger and larger part of people's investment vehicles of GPs. So I think it's really looking at those nuances, and is the GP really giving you equal access to every single investment deal across the platform?
Totally agree. We have a different structure than a partners group, so we invest most of the capital through our own funds, so we solve for the same principle. And that's, again, to your point, pros and cons of different offerings. As long as we agree on the same principle, there are different ways of reaching it. In our case, we have different funds. We allocate to all of them. Therefore, you have certainty that you'll participate to the overall deal flow. And just to cast away any other doubts when it comes to these vehicles being used in the wrong way, well, first of all, there's the name of the firms that are behind. They're not going to ruin their reputation on a vehicle for such a thing. But most importantly, let's not forget, performance in these evergreen funds is accessed since the very beginning and quarterly or monthly, depending on the structure. So the ultimate judge, it's you. So even if I'm talking theoretically, even if there's the wrong house which looks at it in this perspective, you'll be able to find out very quickly, which is clearly not the case of the people of the firms that you have here. But let's not forget that. So it's really
maybe Edwin is the most neutral person to comment on that. So
Caveat emptor. Caveat emptor at the end of the day. It's really down to people, right? I think private equity business, I think the point raised is a good question. I like to argue, I think all the points raised is totally valid, but at the same time, it's down to your picking of the right manager that's right for you. And I think it's going to come down to knowledge and intelligence in the market. And one very important element when you invest in this asset class is people. And I know I'm sitting here for an Endowus event, but this is why you're sitting here, because you have some of the very smart people here. You're going to buy me a drink after this. But it is true, because I think at the end of the day, it's about picking good managers. You look at the past track record, you look them in the eye and say, look, do you trust that these guys are going to bring you the right deals? Obviously, the right structure needs to be in place. But this is also picking people, right? Because they are the one that day in, day out, looking for the right deals, executing on it, making have the right structure, making sure that they have their downside protected, and they have a return target they have to achieve. So people is a key element. And I think, especially at this early stage, for this asset class, for a lot of us sitting in Asia, the people that you go work with, your advisor, is going to be a very, very important piece of that puzzle to pick the right investments.
Yeah, and I guess on the tapping out demand for institutional investors, I probably won't agree to that. We are actually seeing an increasing trend either into private equity or private credit with institutional investors, especially in Asia. However, they have become more selective, right? Because the competitions among GPs have intensively grown in the last 10 years. So with intense competition, probably you get a no, then a yes, and therefore, as a result, the market demand probably say, oh, they're tapping out, right? But no, I think it's just they have become more selective, and especially within the private equity space, for investors who have been in the asset class for a decade, they now would like to deep dive into maybe sub-asset class, regional sector. And in private credit, a lot of the Asian institutional investors, they are actually investing for the first time.
Yeah, no, I just want to add from my side, I think that's really what Endowus is trying to do, and what Sam and Greg have been really stressing this afternoon is the alignment is such an important issue, because we're not paid a commission to, let's say, market a certain fund, and we always look at it totally agnostic to what fund it is, just on a pure merit basis. Whatever is going to increase the assets over time of the client, because that's the way we get paid. I think that's one way of looking at how it's not going to be an inferior product that is kind of offered to you on that way.
Yeah, I was going to add, having our product on Endowus shelf is nothing easier than us getting on any institutional platform.
Yeah, thank you for that. I just have another question on, I guess there's another follow-up question, because again, this is another frequently asked question, again, going back to marks. I think there's still questions on the integrity of the marks. So is it, because I have seen people I mean not people, so GPs that are marking monthly marks based on 1 quarter behind results, and some of them are actually starting to look at marks on a concurrent basis. So do you think there's an industry standard, or are we going through a little bit of a adjustment period where people are actually starting to come around to that?
I mean, look, for evergreen vehicles, there are assurances that we need to get that's independent. There's audited reports as well. And so I think that there is a transition period, as you say. And so I think that there is a direction where there is an industry standard that is moving towards. But at least there are best practices that are in place right now that is in place.
Actually, I'm interested to hear from what you have to say, Hugh, on this one.
So no, what we're observing is that because this is a fairly new asset class, and Partners Group is obviously one of the pioneers of this side. We've when we talk to our clients and they ask about, let's say, a evergreen index of sorts, we actually do show them the Partners Group track record, and people can compare that to public markets, and then you can make your own analogy on that as well. But we are seeing different GPs coming out with slightly different ways of marking. So that's one of the questions. That's one of the reasons I asked that question. Yeah.
Personally, if I would see any different methodology from what Henry described and what also we implement, which is, he calls it best practice, but it's gold standard, I think. Any other methodology to me will be debatable or should be contextualized in a much illiquid fashion. So if you have a semi-liquid which is very specific, very niche, and for which you need to have some weird legs in your valuation, then you need to be very much disclaim it. I think valuations, as Henry described, which is the same methodology we use, have to be reflective as lifetime as possible. So I would say that I wouldn't compromise too much on that. I wouldn't introduce massive legs.
Yeah, so we have about 2 minutes behind, so I'm just going to give everyone last remarks. And part of it is a question that was raised during our alternative symposium that we had in Singapore earlier the year, where we had separate private equity and private credit panels. And I think there was a little bit of a competition between whether private credit or private equity is better. So I'm going to put you on the spot a little bit. So anyone want to go take a shot?
Okay, well, look, I think in this environment, private credit is obviously very attractive. We're managers of both asset classes, right? I can tell you from a relative value standpoint, and we run a portfolio that's multi-asset. We have been deploying into private credit in this environment because of the attractive yields. Yield levels, covenants are also more attractive as well. But at the same time, I think that it's also a very attractive environment for private equity as well. And the reason being is that even though your cost of capital has increased, in fact, your entry valuations have lowered. And so the benefit there, and we've done studies on that, and it's you benefit with about 300 basis points of outperformance. Essentially, because your entry valuations are lower, even though your cost of capital is higher, you do better in a higher rate environment.
All right. You want to take that?
Or maybe even more extremes. As I mentioned at the beginning, the Wallenberg family, which founded us, it's a very industrial family. We are owners. We are active owners of equity. We sold the private debt bit to another market participant. This is not to say the private debt is not attractive, but just to say we specialize in what we're good. We are hands-on. We operate with 700 plus industrial advisors. Our approach is very much equity value creation at the core of it. So when you talk to us, when you come to us, we clearly want to reflect that into the performance, but other asset classes, even when we do infrastructure, we have a very value-add approach. So that's our DNA, and that's what we deliver to institutional clients and to other investors.
Okay, I'm going to ask Tracy to take the private credit side.
Sure. Well, I think private credit is becoming a mainstream, especially as either objective replacement of public fixed income, complementary to fixed income, as well as to deliver private equity-like return in the more illiquid space. the trend will continue because of the expansion of the addressable market. When you look at private credit, it includes a lot of definitions, and I'm sure Endowus and any one of us here would be happy to tell you more about this.
Okay, last comments from Edwin.
The only word I would say is probably take a portfolio management approach to investing. I think that's what we will see. I think that's probably the best way to go about doing it.
Yeah, so I hope you guys took away today that there's actually a new way of investing in private markets and hedge funds, and it's going to be available. It is already available for individual investors through our platform, through our partners. Thank you very much, everyone.
Thank you.
Thank you.